SEC, it was essential that, at least in the view of this senator, that junk bonds or high-yield securities not be part of the investment practices of savings and loans, and so we did change that in the legislation, and I think they have a role to play in the society as a whole. If people want to do that with non-government insured money, that's a different story, but I think when it crosses the line, there is I think that's a different issue, and there is a difference of opinion on the committee, and you may get more of the flavor of that, but nevertheless, we've taken that action, and I think it's a constructive one. Senator Bryan.
Thank you very much, Mr. Chairman. Mr. Breed, I had a couple of questions that were prompted by your prepared testimony. You talked about the movement of capital surplus, as you called it, to the unregulated affiliates, and that you would like to have had access to that information or known about it in a more timely fashion. And the question that I have, is there a regulatory impediment? Is there a lack of statutory authority on your part? What needs to be done from your perspective, from the Congress, if anything, to provide you access to that information?
Senator, we are, as I mentioned, we are engaged at this very moment in an analysis of our current statutory authority in the capital rule area. I think we probably do have ample authority to require much greater advance notice than is currently the case of capital changes, contemplated capital changes, and we're going to look at first proposing the changes we can to strengthen the system within the current law. That, coupled with the passage of the Market Reform Act, which would give us the vital early warning of problems when they're headed in our direction, would, I think, give us what we need.
Could you give us some timeline as to how long the internal review by the agency will take as you examine your authority, and you can report back to the chairman and the members of this committee what additional authority you feel that you need, if any, or at least your overall evaluation as to your operating capability from a legal authorization perspective?
Certainly.
Let me ask you a couple specific questions about the Drexel deal. It was reported that a relatively few weeks before the filing of the petition of the bankruptcy court that some $206 million in bonuses were paid out to employees. Is that information accurate, and if so, is there any ability that the bankruptcy court might have to reclaim any of that money for the benefit of creditors?
Senator, it is true that there were substantial payments of bonuses at year-end. That is a traditional practice in the securities industry at the conclusion of the year. We have, as soon as we became aware of, in this situation, the payment of those bonuses within such a close period of time to the insolvency of the company, we began an immediate, and I directed an immediate examination of the bonuses that were paid, who received the funds, who authorized the payment, and what the authority was. And we have to find out, for example, whether some of the payments may have been the result of pre-existing plans with a formula for compensation that does not involve any improper practice or suggestion of it. There may have been, and I simply don't know the facts yet, there may have been discretionary payments that weren't required. And so we're in the process of gathering the information on who got the bonuses and who authorized them to be paid. And if there were decisions made in contemplation of bankruptcy to deplete the assets of the fund by payments to insiders, then it is possible the bankruptcy court will take some action about that, and it's possible we'll take some action.
So you haven't signed off on that. And I also understand that you're seeking to be appointed to the creditors committee.
Not personally, but
no,
yes, sir.
But as an agency.
We have sought to be put on the creditors committee in a full voting capacity. We are, as you know, one of the major creditors of this organization in our capacity of representing the disgorgement fund that was required to be established pursuant to the terms of the settlement with Drexel. There's approximately $150 million of unpaid obligations of the firm to that fund, and so representing the claimants, the potential claimants in the future, people who may have been defrauded and should have the benefit of those funds to recompense them for their losses as a result of that fraud, we've been seeking to be put on the creditors committee.
Looking at this from a little broader perspective, a number of members of the committee have talked about high-risk investment-grade bonds or non-investment-grade bonds and the functions that they have served in the marketplace. One function that these junk bonds, as they've been called, serve, which I think it's, from a lot of our perspective, I think it's pretty hard to support, is the activity as it relates to the LBO and merger activity, which from my own perspective I think has created major damage to some of our principal industrial operations and has damaged us in terms of our ability to compete internationally. What percentage of the junk bonds that have been issued have been used as vehicles to effect mergers or LBOs as opposed to the other types of activities that have been discussed here by the committee?
Senator, I couldn't give you a specific breakdown of the usage of the funds. It would be very difficult to do because in any financing transaction, dollars displace dollars, and so it would be quite a job to try and trace the proceeds of all the high-yield securities ever issued and determine how many of what percentage had been used in acquisition transactions.
Do you yourself have any concern about the use of these type of bonds for LBO and merger purposes?
I don't, Senator, I don't think that there is, the issue to me is not anything unique to the use of one type of security versus another type of security. If there are problems in connection with change of control contests in terms of the disclosures that are required or the practices that either a bidder or a target can engage in, those problems are problems we ought to look at as issues involving the takeover contest, not that that our view of those issues shouldn't vary based on whether the proceeds for the offer came from a bank loan versus the offer of a high-yield security.
It just seems, though, in the 1980s that the use of the junk bond was elevated to an art form and certainly is associated with some of the more controversial LBOs and some that have had severe financial implications for American industry and American business. And when one reads and looks at these kinds of situations, oftentimes the junk bond has been the vehicle used to accomplish those LBOs and those mergers. Would you not agree that that has certainly been a widespread practice in the 1980s?
Well, I would certainly agree that there have been widespread issuances of high-yield securities, and that in a number of cases the proceeds of those securities were used in connection with acquisition transactions. That, I think, is apparent. I would also concur that many of the transactions may have involved higher leverage in the total transaction, the amount of equity that an issuer of high-yield securities would end up with at the conclusion of a transaction, and the degree of its leverage is something that I think the market has been correcting for some time now. Certainly, if you look at 1989 and beginning as early as June, when integrated resources began to have difficulties with some of their obligations, and throughout the summer, I think July, Southmark defaulted on some, and you had then failure to complete some offerings, ultimately the Campo filing. I mean, the market has been steadily, I think, adjusting its credit expectations. There were some deals which were very highly levered, and I don't think you could do those deals in today's marketplace.
Thank you, Mr. Chairman.
Thank you, Senator.
Thank you, Mr. Breeden.
Senator Graham.
Mr. Chairman. Richard, I think in your testimony you conclude by asking us to act on the Market Reform Act. There is an area of that bill, as you're probably aware, that was very contentious on the committee. In fact, we made a decision on the basis of one vote with the decision to revisit it on the floor. My guess is that area is going to make this bill very difficult to pass in the Senate, and it has to do with the SEC overriding state law. I'd like to ask you, in trying to expedite the consideration of this bill, to look at the broad range of options that the Commission could come up with that might be alternatives to this, such as a procedure whereby the SEC could look at state laws and could make, even on an expedited basis, a recommendation to the Congress that federal legislation be passed overriding these state statutes as an alternative to having a grant of that authority to the Commission. I think if we can do that, we could come up with a compromise that everybody could support, that we could pass this bill through the Senate very quickly. I think failing to do that is going to be very difficult for us to act. And I'd like to ask you to go back and look at that language and see if there might be a possibility, with all the staff you have and all of the resources, that maybe you could come up with a proposal that would allow us to maintain the separation of powers, which has served us well for over 200 years, and yet still deal with a very real problem of state statutes that limit your ability to do your job. And I'd like to ask you to look at that and see if there might be some middle ground we could find. Also, I think a second problem we have is trying to keep this issue from being commingled with the battle that's going on in our sister committee in the House over program trading and the Xerox machine and the telephone and the ballpoint pen and carbon paper. Because I think if we get the issue of trying to give you more power to do your job commingled with that whole issue, we'll never get anything done. So I'd like to ask you to also begin to talk to people in the House if we need the authority in this bill, even if we pass it, unless it can be kept separate from all this other stuff, then I think we pretty well are going to get nowhere in terms of seeing it passed.
Senator, I appreciate the suggestion, and we will certainly do as you suggest in looking at the alternatives. We have tried to consistently to try and remove the obstacles that we could so that the core portions of this bill could pass as swiftly as possible.
Well, I think that'll be very helpful. I guess as I look at Drexel, and I'd like to get your opinion on it, as I look at Drexel, I think basically we have a tragedy in the sense that we had a company that was really on the leading edge of an important technology, a technology that has greatly benefited the country and made us more efficient, in my opinion, and has helped unleash more of the genius of the American free enterprise system, but a company that in trying to cut too many corners ended up destroying itself. Fortunately, because of our strong system and because of effective regulation by you and by the Commission, it didn't do a whole lot of damage other than to its own employees, to the system. Do you have a similar feeling about this situation?
Well, I certainly share your sense of and as I tried to indicate in my statement, we are aware, I'm personally aware of the dislocation that this situation will cause for thousands of employees who used to work for Drexel and for many of the customers, although I think frankly that the customers who utilized Drexel to offer securities have in many cases found a number of other firms who had been trying to increase their share of participation in that market and who will step up to the financing needs that those companies may have. So, but we're not unmindful of that dislocation. It is unfortunate. I don't like to see any major financial institution experience this kind of outcome, but by the same token, it's our job to make sure that cutting corners doesn't go too far, and we've seen some of the damage that can occur from that too. So,
well, I think in that sense, I think it's living proof to another company that looks at that path to make it to success, that path can put you in the ditch as well as on top of the hill.
I would certainly hope that would be the message that chief executives of other companies would take from this situation.
Well, Mr. Chairman, again, I just want to reiterate that I think Chairman Breeden has done an excellent job in the area of Drexel. And I think the story is a good news story, and that is, one, the system works, that cutting corners and cheating does not pay. And yet, if we have someone that abuses the system and tries to bend the rules and pays the price for it, that our system is strong enough that it can withstand the disciplining process, which is unfortunately part of what has to be available in order to induce people to abide by the rules. So I think you're part of a good news story in the sense, while the write-ups on it are almost uniformly pointing out the bad part of it, I think the good news story is that cutting corners didn't work, that market discipline and regulatory oversight worked, and the market was strong enough to survive it.
Thank you, Senator Graham. I think it has to also be added to that, however, something that Chairman Breeden said a while back. The government is now, the SEC is now seeking to become a member of the creditor committee because the government is owed money here that it may not be able to collect. So it's not entirely a good news story when somebody is going to get hurt. There are going to be a number of people that get hurt before the dust settles, and it may well be that the taxpayers will be one party that is injured. Let's hope not. Time will tell.
Mr. Chairman, I think fine money, isn't it?
That is money that has been was agreed to be paid in to a disgorgement of profits and fines. Yes.
Senator Shelby.
Thank you. Mr. Breeden, what has happened to the market makers dealing with the high-yield bonds? I know Drexel was involved in that, and is there a vacuum there now? And will other people fill it immediately, or will they wait and see what happens in the market?
Well, I think to the degree the market has an almost limitless ability, I think, to correct itself for such things. And if there is a demand for a security, if there's a market to be made, people will step forward to make that market. And I think that has been going on. It's not simply a question, will it happen in the future? We've seen that happening already.
It happens logically, doesn't it?
The market actually tends to, I mean, when the final events were announced in the filing of Drexel's parent, I mean, there was obviously great concern as to how the market would react. There actually, in some securities in the high-yield area, the prices rose rather than fell, which indicated that the market certainly had been aware of the situation. The rating changes had been publicly known, and there had been a good deal of discounting of the problem in the market well in advance. So,
Mr. Breeden, I know in not just my state of Alabama, but a lot of states, probably the majority in this nation, that most of their companies could not qualify, would not be able to issue investment-grade bonds. I know in my home state that the high-yield bonds has helped a lot of job creation, a lot of companies access to capital, and they're paying it and so forth. Do you think that the market's going to keep working as far as high-yield bonds? And, you know, there's a demand for capital out there, and with what restraints?
There's no question, Senator, there's a demand for capital. I think that companies, credit-worthy companies, will find that there are still an enormous number of financial intermediaries who will seek to help them meet their capital needs. I would hope that over time, Congress and the administration can work together to also increase the ability and incentives for people to be able to use equity capital rather than different versions of debt securities, because I think the greatest strength and the greatest capacity to make long-term investments for the future by both small companies and large companies comes from equity capital rather than debt.
Would you explain, taking in the high-yield bond area a step further, the phenomenon of collateralization of these bonds, and what is the upside to it? And I know it's growing fairly fast now, or what's the downside risk?
Well, in any in any security, whether it's in this area or in mortgage-backed securities, there's a wide variety of asset-backed securities we've seen over the last 10 years as part of the overall process known as securitization. Institutions taking and issuing different types of pass-through securities in which car loans or lease financings or credit card receivables, mortgage payments, other obligations are passed through to the holder of a security. And to a lender, whether it is a bank lender or an investor in a type of security, a collateralized, secured promise to pay tends to be treated as more valuable than an unsecured, uncollateralized.
Less risk, right?
Because there's less risk, and consequently, the lender, the more secure the lender is, the less the lender charges as a premium for the use of his funds. So collateralization has proven to be, for many companies, an effective way of reducing the interest cost that they might otherwise pay.
And also increasing the market for it, isn't it?
Well, and for intermediaries, it certainly provides liquidity to allow them to replace funds that have been lent out through deriving that investment. The disadvantage or the offset that any given company has to weigh in looking at creating a collateralized obligation is that collateral becomes not available to the degree it's pledged to a particular security. It's not available for future use in other areas, and so there is perhaps in some degree a loss of flexibility in the future traded off for a present reduction in the yield that might be paid.
But if people are looking for more security, this is a different twist to it, isn't it?
Certainly in any type of security, to the degree collateralization is utilized, it reduces credit risk.
Okay. Thank you, Mr. Chairman.
Thank you very much, Senator Shelby. Senator Wirth.
Thank you very much, Mr. Chairman. I'd like to go back, if I might, Mr. Breeden, to the issue of information again and who has what kind of information. We've talked about the information between the subsidiary and the parent, and the issue that you raised in your testimony. Let me try another piece at this about whether you have as much information as you need, or we ought to change the law. In Tuesday's Wall Street Journal, there was a life insurance company ran an ad for concerned annuity policyholders, suggesting that they roll over their annuities to this particular life insurance company. We did a good deal of research on this and found out that this life insurance company has a lot more junk bonds than it does capital or surplus. And then we called up the company and asked them about what was going on in this, and one of the things that they urged in their letter to us was that you be sure to check the bond rating and the amount of funds held in a high-risk stock and real estate. And then they say, check our prospectus, and the prospectus that they send is something that looks like this. I mean, that's the prospectus that's given out to people, you know, hardly the kind of information that...
They give you a magnifying glass with which to read that.
That was about it, right? That was about it. In any case, I mean, the question that this raises, right, clearly goes again to the issue of the information that's available. Another part of this, by the way, let me just give you another part of what was troubling about this. In the material that they sent, they said, quote, this 5-year plan gives you all the security of a bank certificate of deposit plus the enormous advantage of tax-deferred growth. Now, it doesn't give you all the security of a bank deposit, but the implication is that this is FDIC insured. I mean, that's the first thing that I would think, and we're right back where we were. Now, these are securities that we're talking about here, and yet this is an insurance company making these arguments. What does that suggest to you about your jurisdiction or what we ought to do for your jurisdiction? Again, you know, I come at this from somebody when I chaired the committee on the House side. You know, I was deeply concerned about assuring that we had a strong SEC. We maintained the level of regulation and funding over there at a time when there was a great pressure to deregulate and so on. And I come at it from the perspective of wanting to give you all the resources that you need, but you have to tell us what you need and say, hey, we really have to move in this. So, as that is an open-ended question for you, what do you need?
Well, Senator, it's my own personal opinion that that no type of security other than a U.S. government security, but there should not be securities that are exempt from the disclosure requirements provided in the 33 Act, even if they happen to be issued by a bank, which is currently exempt, or a savings and loan, which is currently exempt, or an insurance company, which in many cases is exempt. So I think I think what investors ought to have is full disclosure on a comparable basis of what's behind the types of products that they're offered out there in the marketplace. And so I would personally be very supportive of Congress repealing the numerous exemptions that have been created from the registration requirements under the Securities Act, because where they're applicable, I think they work pretty well.
Could you give us a list of those exemptions that you think ought to be repealed?
I'd be happy to give you a complete list. Certainly sections 3A2 and 3A5 of the 33 Act.
Could you give us a list of the ones that you think ought to be repealed, what changes ought to be made?
Certainly.
In addition to providing the information, what jurisdiction should you have, for example, on the issuance of bank securities, something that we've been talking to you all about? What jurisdiction should you have over, this particular operation, of insurance companies and these kinds of claims, related to what are essentially securities?
Well, I don't think that a bank should be able to issue securities without registering them with the SEC, not a bank regulator, with the SEC.
They now register them with a bank regulator.
Yes,
is that right?
If it's the security of a bank as opposed to of a bank holding company. A bank holding company has to register with us. But today, the issuer of common stock or any other type of security, no matter how sophisticated, by a bank, if the issuer is a bank, that offering is subject to the rules of the banking agencies, not the Commission.
Could you give us also a list of those offerings that you think the SEC ought to have jurisdiction over, which it doesn't now have jurisdiction over?
The types of securities offerings? Yes, be happy to.
And does this spill over? Should you have any authority in this particular area when this kind of claim gets made?
As I said, as a general matter, I think any security that's offered to the public ought to be subject to the registration requirements of the Securities Act. It's designed to provide consistent and comparable disclosure to the public.
As a general principle, that was one of the principles of the Brady Commission as well, wasn't it? That
as well as of the Bush Task Group,
yes.
Even before that. And I think
that has not happened. I mean, the administration has now backed off of that, I understand, as a general proposition. I know you're an independent agency and don't speak for the administration, but
I'm not aware of any backing off in that area.
I asked Secretary Brady about it when he was up here before, about some of the rationalization of jurisdiction issues, and there was not the forthcoming response that was pretty clear, I thought, in the Bush report and in the Brady Commission.
Well, in the area of the insurance products that you're suggesting, obviously one of the problems is that the entire regulation of the insurance industry is currently conducted at the state level, and so in stating my general preference that all securities should be treated under a common set of rules and a common regulatory system, there are products offered by, just as banks offer deposit products that are not generally construed to be securities, and insurance companies also offer products, not their own securities, but certain products that are regulated by the insurance regulator, not the securities regulator. So we don't seek to try and take over the regulation of every financial product, but I do think that we ought to have one securities regulator and one securities law applicable everywhere in the country.
That would true wherever insurance business or Chicago are dealing in securities or securities-related issuance, right?
Right. I mean, on the same philosophy that you have to comply with the 33 Act and go to the Commission, whether you happen to be a computer manufacturer, an airline, a shoe manufacturer, or every type of company in America is subject to the securities law with some exceptions. And I don't see a rationale in most cases for the exceptions.
Mr. Chairman, thank you very much.
Thank you, Senator Wirth. Important question. Senator Dodd?
Just picking up on Senator Wirth's last point, Richard, Senator Hines and I, my co-chair of the Securities Subcommittee, sent a letter on January 4th to Secretary Brady and to yourself asking for legislative recommendations. The due date was yesterday. In response to that, I'm not pressing yesterday, but I think what we'd like is to get some legislative suggestions. I think we have a good idea about how you feel about it personally. In fact, I have a very good idea how Secretary Brady feels about it, he's talked to me on a number of occasions privately about it. But my view is until we get some legislative recommendations, I don't think the subcommittee, I can't speak for the full committee, is likely to want to move into this area. So I would urge that a response to that be forthcoming as soon as possible, because I know of your deep interest and concern in it. And we've got to move at some point on that, at least raise the questions and engage the debate on the questions of jurisdiction and margins, recommendations made by the Commission. So we'll be anxious to hear from you.
I have been trying to make a few casual suggestions along the way as to those, particularly in the margin area.
Keep on throwing the ball up here with casual suggestions. We want some of those fine recommendations, such as that package of legislation from the FCC.
Well, we have, in our own defense, and I can tell you that we have a rather thick set of proposals in response to your letter and that of Senator Hines, and we're also rather overdue in the response to the chairman on some issues, and both of them are sitting, waiting to get sent up here in a very near future. Most of the work is completed now. We do want to get you not casual suggestions, but formal recommendations. In the area of the jurisdictional conflicts, frankly, we've also been trying to work with the other applicable agencies. We're not the only agency with a perspective on this. We participate in the President's Working Group with the CFTC and the Federal Reserve and the Treasury, and we've been trying to also pursue that process of developing a consensus viewpoint to the degree we can before we go off on our own with recommendations that might be our own separate views. So there is some of that work going on.
I'd prefer to have you wait a few days if you can work something working with the other agencies than fine. But again, I'll raise the point only Senator Wirth has raised it. I know the chairman is interested in some suggestions, and obviously we are as well. One of our witnesses we'll have next week, as we look at the industry, has described the present condition of the securities industry as in a period of recession. I'm using his word on this. He says, look, you've lost 40,000 jobs in this business since '87. Profits are at an historic low. Junk bonds are at a very low level. Bridge loans are in trouble. You've got a slump, trading slump that is tough. Layoffs, apparently more are going to occur, even though there's some very operating well. But you start looking at all the things that have occurred, it's hard not to agree that in fact the industry is in a bit of a recession, it would seem. In light of that, simultaneously, as you know, we're facing some of the toughest competition that we'll ever face, or have faced certainly, and globally. And as we're about to enter in 1992, with all the serious issues raised by the globalization of markets and the competition, the attraction to go offshore, I wonder if you might just take a couple of minutes and describe for us what you generally think are the weaknesses and strengths of this industry.
Well, certainly there are some of the problems you allude to are very real, since 1987 in particular, average volume in the brokerage, purely brokerage activities has been down substantially, which results in a reduction of revenue for some firms that's quite significant. Also, the number of initial public offerings and other offerings of particularly equity securities has been significantly reduced. and during the course of 1989, the volume of high-yield securities that were being issued also experienced a substantial reduction. So whether it's in brokerage or whether it's in traditional underwriting activities, there have been reductions in revenues, in some cases quite significant for firms, and they've responded by trying to cut costs, including in the personnel area. At the same time, as you suggest, I think there are a number of strengths of the industry. The United States has only one of the 25 largest banks in the world, but we continue to have, I think it's 11 of the 22 or 23 largest securities firms in the world. We have 5 of the top 10. Our 4 largest securities firms have capitalization that is virtually equal. It's about $1 billion less than the 4 largest securities firms in Japan. So the securities industry in the United States is intensely competitive on a global basis. I think we have the finest innovation and creativity in our firms. We produce new products, and we've consistently shown our strength and competitiveness, so that while there are some certainly current problems given the level given the level of activity in some of these markets, there's great underlying strength.
So you're satisfied that we enter this period in a strong position?
Well, I'm not satisfied in the sense that there are a lot of improvements that we can make, and you and I have had a chance to talk about some of them. I'm not satisfied with a system in which, to the degree one of our strengths is innovation and creativity, that every new product has to be subject to 3 or 4 years of litigation before we can get it out of the courthouse and into the marketplace. Because we are the only major nation in the world that divides the regulation of securities and derivatives on those securities, we are the only nation in which you have to spend 3 or 4 years litigating to find out whether something is 100% a security or only 99.9% a security, in which case the total system of regulation changes. And so we impose on ourselves costs and overhead, in many cases significant, that we don't need to incur and that no other nation with which we compete incurs. And so I'm not satisfied and won't be satisfied as long as some of the things that we can do to improve our own system are left undone. And I certainly hope to work with you and Chairman Riegel and the other members of this committee to try and clear some of these problems away.
Let me, if I can, Mr. Chairman, just one additional question on that point. I don't want to, because I know you've got to move on, but Mr. Corrigan, Gerald Corrigan at the New York Fed recommended, in light of the Drexel situation, that more needed to be done, not just information of the market reform bill, but minimum capital standards is a suggestion he has made. How do you react to that suggestion by Mr. Corrigan?
Well, I understand Jerry's perspective on that, and as you know, the Bank Holding Company Act, which the Federal Reserve administers, does have consolidated capital requirements, and there are some benefits from consolidated capital requirements, no question, in controlling the degree of leveraging of the overall organization. There are costs to that style of regulation as well, and I think you have to be very careful in evaluating. We were just talking a moment earlier about the level of costs on the industry. I'm not eager to do anything that will increase costs, especially where such a step would not increase revenues, create any new lines of business, no offsetting increase in the income side. So I would like to see us start with getting the information about where are the problems and what are the problems, and see if we can't control it with capital regulations, perhaps with some modifications at the broker-dealer level, and then simply those early warning fire alarm kind of provisions that the Commission has suggested. If we find that's not enough as we go forward, we can always come back and suggest other types of changes, but I don't think we need to leap quite as far as Jerry may have suggested at this stage, and I'm just very concerned about the costs of doing so.
And lastly, I just asked you to submit in writing I was going to ask you about the $600 million owed to foreign countries, $120 million owed to Puerto Rico in the Drexel case. That we didn't address this morning here, but it's a major concern, it seems to me, and what's going to happen when my colleague Phil Graham, unfortunately has left, but he talks about, except for a few jobs being lost, Here, it seems to me we're underestimating the implications here. There's been a lot more than just a few jobs lost here when you've got $600 million owed to foreign countries, $120 million owed to Puerto Rico itself. That's a major problem, it seems to me, and I'd like to be interested in your response to that kind of a situation, what needs to be done to provide some sort of protection in that kind of situation.
Thank you, Senator Dodd. You've asked for that for the
I'll
record.
ask Friday because Bob Graham is here.
Very good. Thank you. I have a great interest in that as well. Senator Graham?
Thank you, Mr. Chairman. I'd like to pursue two lines of inquiry. The first follows up on the questions that Senator Dodd was just asking. In today's Washington Post, Chairman Greenspan is quoted as having stated his support for the provisions in the pending legislation that would require holding companies, brokerage firms, to disclose more information about their activities to the Securities Exchange Commission. If you had had the information that legislation would have provided available to you on a timely basis, what difference in actions by the Commission and ultimate impact of those actions on Drexel Burnham would you have anticipated?
Senator, it's difficult to say all the things that we might have done. Certainly, we would have been certain of our ability to restrict movements of capital out of the broker-dealer before they got too close to fully depleting that capital. We were able, because we did find out about the transfers, to put a stop to them when they got to a level in which we were not sure that there was compliance with the capital rules. But a more accurate base of information and appreciation of the overall financing picture of the parent would have helped us be more certain to have been able to accomplish that result. Certainly, we might have worked with the company to help analyze the question of whether, given the pressures that were on them, they should be trying to operate at the size in which they were trying to operate. These firms have a lot of choice. There's no law that made the management of that firm try and run a $28 billion operation, given their level of capital and given the problems that they were having. And we might have, had we known the depth of some of those problems, we might have, even without having any direct regulatory authority over all the parent's operations, we might have certainly encouraged them to consider shrinking the firm down to a smaller and more manageable size and reducing that pressure that came from the vast quantities of unsecured, very short-term liabilities that they had at the parent level. Obviously, one can fairly ask, well, why would you want to find out about the obligations owed to foreign governments or the degree of short-term financings if you're not seeking the specific authority to approve each of those things, to control them? We do think that at a minimum it would be a benefit to be aware of problems as they're growing and to then focus carefully on the operations of the regulated entities to make sure that we have all the advanced planning necessary and take all the steps that will be necessary to ensure the result that happened in this case, that we're able to protect the public customers, that we're able to help them unwind the positions in the firm if that becomes necessary, that other broker-dealers and their customers are not suddenly confronted with a SIPC liquidation or other form of insolvency that might leave billions and billions of dollars of trades interrupted. And we think that's very important. I wouldn't want to say to you that that if the market reform bill had been passed, that Drexel might not still have failed. But I would definitely say that we would have a stronger system of regulatory oversight if we had better knowledge of all the financial exposures, or at least all the material financial exposures that these firms choose to incur.
Follow-up question on that issue. In a number of pieces of legislation, there has been great reliance placed on firewalls, either firewalls vertically between a parent and a subsidiary or horizontally among various subsidiaries of the same parent. Do you have any comments as to what this Drexel case says about the effectiveness of our current attempt to insulate one financial activity from another of a conglomerate organization?
Well, on the one hand, this case certainly shows that merely having separate corporate affiliates, a holding company structure with different companies, will not confine a company's liquidity problems, that when the market becomes aware that there are problems in the parent, that will result in changes in the availability of liquidity to all of the subsidiaries, because the market is going to look and think of this as one company, and there will be an adverse impact on the broker-dealer of exposure to substantial loss in some unregulated affiliate. And that, I think, that risk, which we've been very concerned about for some time, was certainly demonstrated in this case. At the same time, I think this does show that the holding company format with operating subsidiaries that have specific regulatory systems applied to those operating subsidiaries can be made to work and work effectively in insulating a regulated subsidiary from problems occurring out in the parent holding company. There were expectations among some people that notwithstanding the fact that the parent organization here and its other affiliates were unregulated and chose to conduct their business without, as part of an unregulated, uninsured entity, that there would be some obligation of the government to come to their assistance in the event they encountered troubles, and that surely we could not distinguish between the regulated entities and the unregulated ones. And I think that this situation does demonstrate you can make those differences effective. We can and did protect that broker-dealer and its customers, and the Fed moved very strongly to protect the government securities dealer and the government securities market. So I think you have to be realistic that when there is a problem of the entire company, the market will treat it that way. That doesn't mean that there can't be parts of a firm that we will protect to a higher degree than other parts of a firm. And if the system is set up that way and the market is on notice of it in advance, so there are no surprises, then I think that shows that form of regulation can work and work quite effectively.
Mr. Chairman, my time has expired. I have had another area that I wanted to ask about. I'll do so.
If you have just one more that you want to do, or why don't you do that now, and then I've got some. I want to see if Chairman Breeden can hit the fastballs over the middle of the plate here, so I'm sure he can.
Well, I think this is going to be a slow curve because of the outrage of the absence of spring training. The pitchers are not at their form that they should be. Returning to the earlier discussion about the
Senator,
use
I
of...
left my batting helmet back at the office, so be careful.
Returning to the earlier questions relative to junk or high-yield bonds, one of the explanations for the expanded use of this particular form of financing during the decade of the 1980s was that the access to some of the traditional capital markets for smaller emerging firms, particularly equity financing and financing through commercial banks, was either unavailable, less available, or not available at terms that were as attractive as those that were now available through these high-yield securities. In light of what is a significant reduction in the availability now of high-yield bonds, how do you see these more traditional forms of financing entrepreneurial ventures in their ability to pick up that part of the market that the high-yield bonds have been providing during the 1980s? And as a follow-on question to that, if there are any restraints on these more traditional areas, possibly restraints which contributed to the emergence of the junk bond market. Do you have any recommendations to this committee for congressional action, or are you considering any administrative action through your position that would help mitigate those restraints?
Well, Senator, it's certainly an excellent question. And if I could start at the end of the question and work my way backwards, I don't think the high-yield market arose out of regulatory restrictions or other artificial barriers, if you will, to more traditional forms of intermediated credits, specifically bank loans. The fact of the matter is that financing with high-yield securities proved to be cheaper and less costly than financing with equivalent intermediated bank loans. In that regard, that fact is not unique to high-yield securities. Commercial paper has virtually displaced short-term bank financings for major American corporations. 20 years ago, large U.S. corporations might go to the bank to finance their short-term activities. Today, they simply issue short-term commercial paper, and the reason they do is it's cheaper. Similarly, the reliance on long-term investment-grade securities has, as opposed to long-term bank loans, has increased. And so as part of the phenomenon that people often refer to as securitization, what we've seen is across the types of credit quality spectrums, the fact that the securities system that seeks to match up the ultimate investor and the ultimate user of funds with the intermediary, not taking the credit risk and not funding it with their own balance sheet and the cost of capital of the bank's balance sheet, but rather just simply facilitating the movement of funds from the ultimate investor, whether it's a pension plan or an individual investor, to the ultimate user, that process is more efficient and cheaper. And it's one of the reasons why we need to go back and re-examine and make some alterations to the Glass-Steagall Act, because the traditional market of the banking institutions for intermediated credits just simply isn't nearly as efficient and can't produce funds for the users of that credit at as low a cost as can securitizing credits. And so I don't think that there will be a disappearance of high-yield securities, of the availability of securities for companies that in that part of the credit spectrum that have financing needs. There may be changes in the prices that they have to pay, which the market all the time will reevaluates the risk and return ratios that are expected. But I don't think that that type of security is going to dry up, because it's efficient and there's a need for it. And there will be plenty of institutions that will provide it.
Thank you, Senator Graham. We may touch on that a little bit more here. I want to go through several items that I think are very important for us to pinpoint. First of all, I'm wondering what impact, if any, do you think the Drexel failure should have on this larger question of financial services modernization and the future regulation of financial holding companies?
Well, I hope it will be an incentive for us to move more quickly rather than for us to hold back. I think it's very clear that there are a number of areas in which the current system, in my judgment, ought to be modernized. There are international competitive reasons we ought to do that, and there are stability reasons we ought to do that. We can make a more competitive and a safer system, and I hope that this event will help move us toward forward in that process.
What kind of regulatory framework, then, is that likely to require?
Well, I would hope that it would include enhancements, as we've discussed, to the oversight over holding companies of broker-dealer firms. And we can look as the legislative process goes forward at the degree of that type of oversight, but at a minimum that we ought to have more information than we now get about those types of activities and their firms. I would hope that we would re-examine carefully, as Congress has directed to occur, the scope of deposit insurance in our system. We have trillions of dollars of underwritten funds, and the question of how much the taxpayers ought to have to underwrite of the exposures of banks and thrifts is something that I know the Congress is interested in, and I think we may be able to make some improvements in that area. I think that the fragmentation of the oversight structure among federal agencies as well as between federal and state agencies is while perhaps once was a luxury we could afford, I think is increasingly doing damage to our competitive posture in the world, and that we ought to look very carefully at creating a national integrated securities market, a truly national market, and a national banking market as well. Obviously, there are a number of concerns in the areas of the role of the states in regulation and supervision, and in the importance of locally owned institutions that we can't disregard. We have some important traditions in this area, but I think we can make some improvements that will increase the liquidity and the efficiency of our market.
When you mention fragmentation, what do we need to overcome the fragmentation on the regulatory side?
Well, we're reviewing a variety of ways in which we might do that. That is the subject of much of the inquiry and analysis that we're trying to engage in with the President's Working Group. I think, have to look at, and one of the difficulties in answering that, Senator, is in part it's not a standalone question. It does also relate to what kinds of changes are being made in these other areas. If we're going to change, perhaps completely repeal the Glass-Steagall Act, that has implications for the kind of structure that we ought to have in regulation. If we're going to either, depending on how we treat deposit insurance, that has implications for the regulatory structure. So it's not something that I can say, well, there are three things that in all cases, irrespective of what happens in those other areas, ought to get done. I would certainly like to eliminate the fragmentation that now exists in to the degree we can between the securities market and the derivatives on securities. At least if we can't eliminate the oversight fragmentation, then we need to find some way of coming to grips with the very real problems it creates. The litigation that I spoke of earlier, the potential for intermarket fraud with single transactions crossing the line between two different sets of policemen, the potential for instability that can be created if you have dramatically different leverage rules in different markets. So there are some, I think, improvements that we have to look to in between the securities and the derivatives on securities. I would like to see a reduction in the number of different agencies that regulate securities. And as I was speaking of earlier, with Senator Wirth, the fact that we have not one securities regulatory agency at the federal level, but we have 5, because the Comptroller of the Currency and the Federal Reserve and the FDIC and the OTS all regulate offerings of securities under essentially the 33 Act, and all regulate ongoing 34 Act disclosures. I think we could centralize that activity of the regulation of securities offerings and securities disclosure under one agency. So there are a number of areas. As you know, it can produce a 400-page book, and I don't want to give you an hour-long filibuster here about it, but
let me go to one other specific point. I think you've made some useful suggestions in your response, and that is, if one envisions, say, doing away with Glass-Steagall, as you mentioned, or the Bank Holding Company Act, does the Drexel experience and the movement of money back and forth between the affiliate and the broker-dealer tell us something about the importance of real firewalls and tough firewalls? I mean, firewalls that we understand and that will work, and with severe penalties that hang out there if anybody tries to circumvent the firewall protections?
I think the Drexel situation shows us the importance of asking in advance what the level of government involvement with any particular type of operating company, whether it be a subsidiary bank or a subsidiary broker-dealer, what the nature of our interest, our public interest is. Is it deposit insurance? Is it protection of brokerage customers? Is it protection of the system? To make sure we have in our minds the goals we're trying to achieve, then set clear rules of how we're going to achieve those goals, and whether it's capital requirements or firewalls against self-dealing and other types of activities that we may conclude are potentially damaging and harmful, and then have very realistic systems for oversight and for deterrence to make sure that when we decide a rule is necessary, that it gets enforced and obeyed. And we have a great many of those protections, and I think we can move to reducing some of the arbitrary barriers. I think we could substantially modify Glass-Steagall. I think we could substantially modify, if not eliminate, the exclusivity clause in the Commodity Exchange Act. There are a number of these arbitrary competitive barriers that we could remove and have a regulatory system of holding companies with operating subsidiaries that would be effective. But as you say, I think firewalls are very important in that process, are an essential part of the process. We have to take a look at what kinds of things we want to prohibit. We may not need to prohibit all cross sales of products, for example, but certainly the kinds of self-dealing and fraud questions and the kinds of financial accounting questions that are raised by some of the intra-group transactions that may occur are critical, and we need to regulate those activities.
Well, let me take that point over into a different area. That obviously depends on having very competent regulators. I mean, you have to have people that know what they're doing, and they've got to have the resources they need, and they have to be vigilant, and so you got to have good structure, good system, good personnel. You really have to be on top of things. And you obviously, as the chairman of the SEC, enjoy the confidence of this committee, as I and others have expressed today. But when I look at the Drexel situation, the Drexel Board of Directors consisted of numerous very sophisticated individuals, including two former chairmen of the Securities and Exchange Commission, people that sat literally right where you're sitting today before this committee and testified on these very issues, and were the principal supervisory regulator of the securities markets and activities. And I must say, I'm having a hard time in my own mind understanding the responsibilities of an outside director of a broker-dealer and the extent to which those obligations, however defined, were really carried out in this case. It really is somewhat striking. I mean, there hasn't been much focus on that we could have such a body of expert people, one would think, right in the central command center of that company and on the board of directors, and yet somehow not fathom what was going on or stop it or correct it or in some way see that more prudent steps were taken. So is the SEC looking into the activities of the Drexel Board of Directors?
Senator, we are trying to look at, in a very comprehensive way, everything that occurred in the course of this situation. I would not want to single out any particular individuals in answer to your question, because we intend to do a very thorough review of all the activities and the participation of the different individuals in those activities, particularly where the particular decisions may have impacted on the likelihood that, for example, the final payments would be made to the disgorgement fund under the settlement, which is actually a part of the settlement agreement, that the firm do nothing that would imperil the completion of its obligations under the decree and the settlement agreement and the court decree that enforces that, to take a look at steps that might have been taken that could have prejudiced the broker-dealer and not been in compliance with our regulations. So I think you can be assured that we'll do a thorough review as we go forward of all the actions that occurred that were significant, and be able to report to this committee and to ourselves, really, in determining what appropriate action ought to be taken.
Do we have a clear understanding as to what the responsibilities of an outside director now would be in a broker-dealer? Is there a clear setting forth of what those obligations are so that we have something to measure against?
Well, there'd be two types of obligations. One would be the obligations that would arise under state law for any type of corporation incorporated in the same state. There are fiduciary duties that directors of any corporation, including a broker-dealer, have to the shareholders and to others. In addition, there are special obligations that officers and directors of broker-dealers have by virtue of the securities laws, by virtue of the regulations of the applicable self-regulatory organizations, the New York Stock Exchange in particular, and the NASD, other, whatever in a particular case the appropriate SRO would be. So I would hope that directors in each case would be fully aware of their responsibilities that emanate either from their general status as a director under state law or specifically from the securities laws. And I don't think there should have been any lack of awareness of the duties to which they were subject.
Now, with respect to any possible enforcement actions based on a failure to supervise, is the SEC likely to bring any enforcement action against anyone here at Drexel based on a failure to supervise matter?
Senator, I can tell you that we are likely to consider all appropriate actions. As you know, I could not, it wouldn't be appropriate for me to make predictions of actions that we might take before the Commission, in fact, voted to take those actions.
Yeah. Well, let me ask you to do this for the record. I appreciate the sensitivity and the difficulty and the importance of making that assessment. I think the committee needs to have for its records and its purposes what the SEC sees as the requirements of a top executive of a securities firm to supervise properly. In other words, I'd like to know what there is in the way of either an established code of conduct against which someone's actions might be measured, or what that is thought to be if it's not in writing. I'd like to know what it is that's in place as the standard, and if you could give us that as apart from how anybody in this case measures against it,
certainly
that would be useful for us to have.
Be happy to do that.
Let me move now to commodity transactions. According to a number of different sources, immediately preceding the bankruptcy filing, apparently Drexel's commodity trading subsidiary engaged in a series of transactions. What kinds of commodity transactions took place, and were these in any way unusual?
Well, I can't tell you what kinds of all the types of commodity transactions that the affiliates of the broker-dealer may have engaged in outside the broker-dealer and for the account as a proprietary matter for the accounts of the Drexel, the firm, for its own account. The two types of commodity transactions in general that were going on, customer transactions and proprietary transactions on their own account. The customer transactions, by and large, were going on in the broker-dealer. And there were commodities accounts that were conducted for customers as part of the broker-dealer, and I'm not aware of any problems arising out of that type of trading
upstream?
Or unusual. There was a substantial amount of commodities activity at the parent level or some of the affiliates. There were transactions in a number of metals, including gold and platinum. There were transactions in oil and I believe gasoline. There were transactions in a whole variety of commodities. I'm not sure that there were any commodities they didn't transact business in. But I can't give you a full list of everything that they traded in, but it was very substantial in size, amounting to more billions, not millions of dollars of trading. They were very active in currencies. They were very active in all the bullion markets. This was a major trading firm, and they conducted, like other major trading firms, activities all over the world in the major markets in major commodities.
Was there a burst of commodities activity as we were getting close to these very severe difficulties, and does that appear somehow to have show any kind of a pattern to try to through speculative trading of that sort to try to save the company? Is there any sign of that?
I don't know. I mean, this is activity. This gets back to the question of the scope of our authority. I mean, this is going on outside the broker-dealer. We get no reports about it. We have no legal authority to go in and
do we know enough
on
about the volume, as of yet, I know you're collecting facts, do we know enough about the volume of commodities trading activity? You say it was in the billions. Did it seem to be above the normal levels, and was there a burst that occurred just prior to the demise of this company?
I'd be happy to take a look at that question to the degree we have. I'm not aware that there was a special burst of activity, but I'm more aware of just the levels. When we became aware of the depth of the problem and got current reports as to where they were at that particular moment in time, and I don't have a good picture.
Well, let me ask you a different
over time how that may have ebbed and flowed.
Let me ask you a different question. As private capital sources were drying up for the affiliate, and money was being taken out of the broker-dealer, and money was being taken out of the broker-dealer and upstreamed into to the affiliate, was that money being used for commodity trading?
I think some of it may have been used either in trading or to repay obligations that were coming due. There was, as I mentioned, more than $1 billion of short-term funding at the parent level, and that consisted of commercial paper and then a number of commodity markets financing transactions. And as their access to the commercial paper market shrunk, their reliance on the commodity markets as a source of funding grew. And they did conduct a number of transactions in which they were engaging in short sales of different types of commodities and using for a temporary period of time the proceeds of those transactions with a repayment obligation. And there may have been a use of some of the excess capital that was moved out of the broker-dealer to pay down some of those obligations or to satisfy some of those obligations as they came due. Now, when I became personally aware of the capital movements out of the broker-dealer and looked at the volume, and at that time there were more than double the total remaining capital of the broker-dealer in these types of short-term obligations, I decided that we should not permit any further transfers and that the capital rules, we were not confident that they were in compliance with their obligations, so we put a stop to this. But there was a substantial volume of these financing transactions, billions occurring every day, and so I don't want to be unresponsive, and yet I can't tell you. We don't yet know all the facts, and we're continuing to look very carefully at it.
Well, it sounds to me like what may have happened or what potentially could happen, but I go back, what may have happened in this case is that the parent was draining capital out of the insured affiliate, if you will, in the insured broker-dealer, taking it upstream, having a real liquidity crisis as private sources of borrowing were drying up, took a lot of gambles in the commodities markets or futures markets or options markets where if the market went the right way, they could recoup, but then they at least bought themselves some time, at least to let the gamble play out. And of course, if the gamble goes the wrong way, then you not only could lose the money in a desperate way to try to save the company, but also end up exhausting the resources out of the broker-dealer. Now, you intervened at a point here and put a stop to the movement of the money out of the broker-dealer, but is there any indication that that may have been what was going on here?
Well, Senator, I want to be very careful because I don't want to create the perception some of these transactions in some of these commodities may sound quite esoteric, and I think to the ordinary person they are. There were, as I said, this was one of the largest securities and commodities firms in the world. It was actively trading, and in many areas that trading may have been very professionally and competently conducted. There were, for example, in many of these commodity transactions, they were quite frequently hedged rather than being purely speculative positions, and where they've had offsetting positions.
So you had both kinds. You had the hedge positions, but then you had the standalone positions that would be...
There may have been some standalone, more speculative positions. I say this gets difficult for us to know because the offsetting hedge transaction
we don't monitor that, do we?
Right. No. Well, we don't. There's no one that monitors the entire organization and everything it's doing. And
would the CFTC have been monitoring that, do you suppose?
Well, the commodities exchanges, some of them domestic and some of them foreign, in which they were taking positions, would all have been monitoring on a daily basis the position of the firm in their exchange and its level of margin, its level of exposure. The CFTC would get reports and was undoubtedly monitoring their positions in the domestic exchanges, although not all of their positions by any stretch of the imagination.
So there was really nobody watching that we know the whole pattern of activity in the affiliate where this was going on, I take it. Is that right?
There was no single regulatory authority that had oversight or jurisdiction over all their activities in all their different markets that they would have been participating in.
And if I'm right, $300 million was moved upstream out of the broker-dealer while this problem was coming to light, and something happened to it. Maybe it's still there, maybe it was lost. We don't know, I take it even yet, fully what would have happened to that before the gate came down and you stopped the movement of capital up into the affiliate, where part of it, at least, was being used for those kinds of transactions.
Well, actually, the number was larger than 300 million. It was probably in the 400 millions that was ultimately moved out of the broker-dealer. I can't tell you.
In a short space of time?
Well, over the period of a month.
Yeah, it's a pretty short space of time.
So if that's what we mean by short, and given that we're looking at a 50% contraction in the capital base in the space of a month, it may have in fact happened on one day or in over 3 or 4 different days spread over a month. I don't know the precise sequence of that, but it was over a fairly compressed period of time. I don't know what all those funds were used to do.
Will you be able to reconstruct that now? Do you have sufficient authority as things stand today to be able to piece that puzzle together, or can you be blocked from, even after the fact, assembling all the information?
Well, I don't know whether we have any blockages down the line that we will encounter. We are trying to rather vigorously take a look at the transactions that occurred, the movements of money within the firm. I don't know that we will have the ability or authority to necessarily reconstruct, and I'm not sure I would want to try to reconstruct all of their daily trading activity everywhere in the world.
Well, I'm not talking about each and every last. I'm talking
but as
about
to
where,
where the, in a sense, I also want to be careful here that they were taking funds that were not at that time. They may not have been required to have been kept in the broker-dealer, and therefore it may have been perfectly legitimate to use what was not required to be in the broker-dealer elsewhere in the company. So the fact that I would not want to discourage firms from over-capitalizing their broker-dealers by suggesting that they could never, once they put money in a broker-dealer, that they could never take it back out again, even if it was well in excess of their requirements. So it is not necessarily true that there was any wrongdoing or misapplication of those proceeds. The speed with which they were occurring and the trend, when you see the bottom fall out of the bucket and the water all disappearing at that rate of speed, caused us to re-examine their capital position. And we will try and find out, to the degree we can, what usage was being made of those proceeds.
Well, that's an important point, and I hope you'll pursue that, and we want to help you pursue it. But I have to come back to the fact that the SEC is now asking to go on the creditors committee because you've got, what, $125, $150 million? $150 million outstanding, which you may or may not collect. The reason you want to get on the creditors committee is you're concerned about getting the money that's due the government. So even though there was an intervention, we can't say today whether the intervention was timely enough because we still don't know yet who's going to take the losses. I mean, Senator Dodd talked about some foreign governments that are not just foreign governments, Puerto Rico being outstanding, holding the bag and so forth, but we are, as the SEC is, as a matter of fact. I mean, that's why you're seeking a spot on the creditor committee, isn't that right?
There is no question that there will be losses for creditors as a result of this failure. Creditors of the parent corporation and creditors of its affiliates, unregulated, uninsured affiliates. And if the government of Puerto Rico or any other lender chooses to extend credit to an unregulated, unsupervised, uninsured trading company that happens to be owned by the parent of a broker-dealer, there is no guarantee there that they're dependent on underwriting the quality of that extension of credit and making sure the people they lend the money to have the capacity to pay it back. But there will be creditor losses. We are a creditor also and are concerned about that. So I would hope that those losses can be minimized. We have avoided losses to the customers of the broker-dealer, which is not in bankruptcy, even today. It's never filed for insolvency. It has maintained its compliance with its capital rules. It is in compliance today with its capital rules. And we've been able to wind down its portfolio in an orderly manner. So I think if I can divide for you, we have been successful in preventing the customers of the regulated entity from suffering a loss. We did not have the obligation to protect creditors of the holding company, and there will be losses at that level. Two other really quick points. One, we are a creditor at the parent level. I'd like to just make it clear we are not a creditor in our own capacity. We are a creditor as a representative of the beneficiaries of that fund. And secondly, we have not been admitted to status as a voting member of that creditors committee, and we think that there's a pretty good argument under the law that we ought to be admitted to that creditors committee, but if we're unsuccessful in that effort, we may need to come back to Congress and suggest an examination of that area to make sure that in this type of situation, which I hope is never repeated, but that if there were to be this type of situation again, that our ability to protect the beneficiaries of such a fund is absolutely clear and unequivocal.
I'm going to ask you one other question now and then give you some questions for the record. You've been very patient, and we've got another very important witness that we need to hear today. And let me ask you about the bonuses. It's reported that Drexel paid $350 million in bonuses to its employees in the 2 months preceding the bankruptcy filing, which is very close to the amount of money that Drexel apparently needed to continue its operations. And I'm wondering, is it possible or is it likely that Drexel management believed that the company's collapse was imminent and that the bonuses were just one final way of getting funds out of the company? Let me ask you that first, and I have a follow-up to that.
Mr. Chairman, I think that is one of a number of possibilities, and we don't know whether that was in fact the motivation for any of those penalties, any of those payments. I can tell you that immediately upon learning of the size of the bonus payments, we commenced an inquiry, which is going on as we speak, to the payments that were made and the facts and circumstances under which they were made, and we're going to continue that activity and that investigation until we have all the facts.
Is there any power that you have to rescind those payments if you find that they were inappropriate?
Well, certainly some of them, depending on the facts, could potentially be preferential payments for purposes of the bankruptcy proceeding, and could be
disgorged?
Could be repaid, as any preference in contemplation of bankruptcy under the Bankruptcy Code can be recovered. So the Bankruptcy Code is certainly one area, and as a creditor there again, we would have, like other creditors, a right to seek to have preferences set aside. We may have other authority in this area, and the nature of that authority may depend on the facts and circumstances, and I'd like to not speculate unduly on the kinds of things we might do to respond depending on the facts as we find them.
Does the SEC have the power to, if it should decide to do so, to take an enforcement action against a Drexel executive who ordered that bonuses be paid if you find that they were improper?
We have there's a lot of conditional elements in the question there. We have pretty broad authority to take enforcement activity against any behavior by an officer or director of a broker-dealer that is improper under the standards of the securities laws or the operating requirements of the exchanges, which, as you know, are quite extensive, so that if there was improper conduct under the governing rules and standards of conduct, I would say we have very broad authority to respond to it.
I'm going to finish by saying the letter that I referenced at the beginning that was sent in October on the nature of the junk bond market, who holds junk bonds, the whole question of, which is now even a more relevant question in terms of how this market works, how quotes are established, who makes the market, with Drexel out of the picture. Those are very important questions. I know you're in the process of finalizing a response to that. We need to get that, and I know you're working on it, but I want to ask again that that work be finished so that we can put that in place with the other information that we're gathering now.
Mr. Chairman, I recognize that number one, that it's important information that the committee needs. Number two, that you've been extremely indulgent with us in our trying to assemble in a comprehensive way that information. I would expect that you'll have that information, that report, next week, and I'm doing everything I can to try and get it to you in a timely way, and we appreciate your cooperation in working with us on that.
I'm going to give you some other questions for the record. There are a number of questions from colleagues, too, that they feel importantly about, and I know you'll respond to those, too, as quickly as you can, because we want to complete the committee record and get it into print. Let me thank you for your testimony and excuse you as a witness now, and I want to call Mr. Kohlberg.
Thank you very much.
Thank you.
We'll continue with this hearing after a short break for programming information. The Senate Banking, Housing, and Urban Affairs Committee took a short break at this time.